Hey everyone, Randall with RESNN Investments here. And today we're going to go over actual results from a real estate private equity deal. Most follow a pretty typical setup. And in this video, I'm going to show you one particular deal that I'm actually currently invested in. I'm actually going to create a few of these videos so you can see a few different deal structures. But know that even though I'm showing you actual results, I've got to put in a little disclaimer here that this doesn't guarantee that your results will be the same. These are just typical scenarios. They are actual investments that I have made, but please understand that. So let's take a step back first and just talk about what real estate private equity is. I like to say it's direct ownership of real estate without the headaches and with steady passive income. But what is it specifically? Well, ultimately, you invest in a company that's going to purchase a building or multiple buildings that generate rent. And that rent is collected and distributed to you in the form of what they call distributions. And the type of buildings that they will invest in are all over the gamut. They could be apartment buildings, retail like strip mall or malls, medical buildings, industrial, office space, self-storage, even single-family homes. But ultimately, most times the deal structure is very similar, where, again, they're buying a building. They might be improving it in some way, but the goal is to collect rent and improve the value of that property and ultimately sell it for a profit. So from a financial perspective, what does a typical deal look like? Well, generally the deals in terms of length are 3 to 5 years, and they're broken down into kind of 3 different blocks of time. The first third of the deal is where they're actually going to be buying the properties. And generally, ahead of time, what they're going to be buying, but sometimes not. And then after that, they focus on what's called value add. And that's where they're improving the building to make it more valuable. So a typical deal is they're going to buy, and I'll use the example of an apartment complex. They're going to buy an older building. It may be 20 or 30 years old. It may have outdated, HVAC units and things like that. But also it might be the paint is looking a little sorry. The interior of the buildings are, needing updating. And usually these are buildings they're buying in desirable parts of town. So in a sense, they're trying to find the worst building in the best neighborhood. And so years 2 and 3 are usually spent adding that value. And it might be something as simple as, updating the kitchens, putting granite countertops, removing the linoleum tile. Instead of carpet on the floors, they're putting pergo flooring, things like that. Ultimately making those apartment buildings more valuable and therefore justifying a higher rent. So the goal is, as I mentioned a second ago, to increase the value. And the way they do that is making it more desirable and therefore ultimately raising the rent. And this is on existing tenants, but also the focus is on getting the building to full occupancy. And obviously by making the buildings more desirable compared to the competition down the street, that's going to be easier to do. The next 2 years is what is called rent stabilization. And ultimately what that means is we've done our improvements, we have the place rented, and we want to show consistency to a potential buyer down the road. So we want to show that, there's no oddities, that this place is rented and it has been for 2 years. And there's nothing fishy about it. It's just nice and consistent. After that's done, then it's ultimately trying to find a buyer to take the property off your hands and finish the deal. And with those improvements and higher occupancy, clearly the building is more valuable at that point and therefore warrants a higher price tag. It's important to note that before you invest, you're going to know the terms of the deal and what you can expect in terms of money coming back to you with a timeline. But I do want to show you in this particular case what the expectation was for this deal. So if you look at the sheet that I just popped up, in the top half, you'll notice that it says 100% of available distributions are paid to the investors as follows. So the first step in money flow is what's called a cumulative preferred return. And in this case, it's 8% paid quarterly. So ultimately what this means is you can expect 8% of your original investment to be paid back on an annual basis quarterly. So in a sense, 2% is paid every quarter back to you. Is this guaranteed? No, it's not guaranteed, but ultimately the sponsor, the general partner, is not getting paid before this time. So they definitely have an incentive to get you that money. And you can expect that along the entire length of the deal. So as years go by, that 8% is going to keep rolling in. And that's that steady passive income that I was talking about. It's important to note in this case, the word cumulative. Some deals don't have this. I actually won't invest in any that don't. But in this case, what that ultimately means is if for some reason they can't pay that 2% for a particular quarter, they owe you it. And again, not guaranteed, but they don't get to enjoy the proceeds of the deal unless they catch up. So after that 8% is caught up, then they focus on returning your money, your original investment back to you. And once that occurs, then any additional profits get split between you, 70%, and the sponsor, 30%. And again, this is this particular deal. Doesn't mean every deal is going to be like that. In this case, they're targeting an IRR, or in a sense, an annual return of 13 to 15%. And what that means is that at the end of the deal, if you were to take all the money you received and divide it by the number of years in the deal, you can expect that you have approximately a 13 to 15% deal. Again, not guaranteed. This is what their target is. This is what they're goaling for. And so in this case, you're getting 8% a year. And then when they go to sell the property and they're getting a big chunk of money, that ultimately means you're going to get a big chunk at the end, which equates to 13 to 15% for that investment. One other thing to note on this page is this 1.25% asset management fee. What that means is they are charging you each year 1.25% to manage the properties. And this is very normal. And ultimately what that means is when they collect rent, first, they're going to make sure that they're getting that payment. And then the rest of the money gets passed out to you in this preferred return. So they are getting money, but it's a small amount. I mean, they're going for the 30% here. That's really where they make their money, not in the management fee. All right. So if we look at that in terms of distributions, generally you're going to see the money that comes back to you orients around the timeline that I discussed earlier. So usually in years 1 and 2, you can expect to see smaller distributions since the sponsor is pumping most of the money that they're receiving in rent back into the property. Again, with the value add, they don't have a lot of free cash flow. And so you can anticipate that those checks are going to be smaller. Then in years 3 and 4, they generally start distributing the profits to you and catch up any missing or low distributions from the first few years. So again, getting that 8% a year cumulative into your pocket. And if they still have extra cash, then they're going to start returning money, your original investment back to you. So they're taking care of those first two priorities in the waterfall structure and the money structure. And then obviously at the very end, when they do their final sale, then you get a large check. And of course, they're going to get paid at that time as well. So let's look at some specifics. Again, I'm going to take you through a typical deal, one that I'm actually invested in. This is a deal that was around 5 years. I think it was a 5 to 7 year deal, and we're still in it. We're still in that deal. And in this case, this was what's called a fund, which is they actually were going to buy 22 buildings with approximately 300 units in each. These were apartment buildings. So in a sense, your one investment purchased 6,600 doors or apartments. And I loved this deal because it was really well diversified. The apartment buildings were going to be in multiple states. Obviously, with 22 buildings, you're minimizing risk in terms of some big problem on one particular property. All right, so let's dig into the actual financials of how that deal played out. So the first thing is I committed on February 5th, 2018 to the deal, and they asked for a 10% check, which you can see here. I invested $5,000 into the deal. And that's pretty normal where they want you to commit the money, and then there's a future, what they call a close or future date where they say the rest of the money is due. And in this case, it was May 14th, where they wanted the rest of the money in $45,000. So if you look over on this column, you can see that my original investment was $50,000. And when we scroll down, we'll see that as they start paying back my money, my investment in the properties are lessening. I'm getting money back, if you will. So in this case, they were pretty quick to start sending money. You can see that in July, they sent a check for $342.93. And that equated to a 4% IRR. It's a small check, but ultimately, if the deal were to end at that moment, it would have been a 4% return on my money. Obviously, that was not the plan. And as they're adding their value through the next number of months, we are getting some payments. The next check was in October, and it was for $1,267.90. And what's interesting to note here is that obviously that was a little bit larger check than the first one, and it brought us to that 8% cumulative that they promised in the original deal. So since they short paid, if you will, that first payment, they've now caught up on their commitment. And we can see that if we continue down a little ways, that this continues with payments along the way. I still have $50,000 invested in the deal, and they're just paying us those distributions as rent is coming in. They're staying consistent with that 8%. And what happened here in March of 2020, we had a smaller payment suddenly. And in this case, it was in the beginning of COVID. And obviously there was a lot of nervousness around, are people going to pay rent? What's going on? And so they actually sent out a letter and said, hey, we're gonna pay you a little less this quarter. We want to hold a little bit of cash just in case. We don't know how this thing is going to play out. And so you can see they sent us a check for $500 even, which means they had a commitment to catch up or get back up to 8% of the pref. And sure enough, in the very next quarter, they sent us a very large check, got back up to 8%. And in this situation, this is the first time they started paying back our original investment. So you can see the check was for $1,940, and that was broken down by $1,400 approximately, got us back up to that 8% cumulative preferred return. And the extra was used to return our money. So now instead of $50,000 invested, we have $49,500 invested. So we're starting to get our money back. They're still paying the 8% pref. And as we go down a little further here, you can see the same thing happened in the next quarter and the next quarter. We got these nice big return of capital checks, and they're staying consistent with their 8%. In March of 21, you can see that they did not return any capital in this case, but that's okay. They don't have to yet, and they stayed consistent with the check. So for whatever reason, they just did not have as big of a chunk of money at that moment, but everything's fine there. And it's kind of important to note that you don't always know ahead of time. You can kind of assume that 8% is going to be coming in 2% a quarter, but you don't necessarily know, is there going to be more included until a few days before when they'll send out, email saying, here's what we're going to pay out. Obviously, in June of 21, you can see they sent us a very large return of capital. And suddenly now we have almost $8,000 returned, and everything is running very well with the investment. December, another nice large check, $6,000 check, and everything is just flowing along. And then we get to July of 2022, and this is obviously an extra payment if you look at, each quarter we're getting paid, this is an extra payment. And what ultimately happened here is they sold one of their buildings and they got a big check and they distributed that out. So in this case, they gave us a little bit of preferred return. Most of it was return of capital. And suddenly we're at a point where we've had half of our investment returned already. It's looking much less risky at this point in the deal, looking fabulous, actually. If I keep scrolling down to current, this pattern continues. They're continuing to pay consistently that 2% a quarter, returning capital along the way. And we are now at current in this case. One other thing I wanted to mention, what's this tax withholding? So there are times where they will actually file a tax return in a specific state. And in this case, it had to do with the sale of that building where they wanted to hold some money back. And it is your money, it's being sent to a state's tax revenue. And so when you file a tax return, that will be accounted for. You will get that back, or it will be applied towards your taxes, if you will. So let's scroll down and look at kind of what the results look like for this deal at this moment. So the total return, the total money that we've gotten back in terms of pref is $16,682, which amounts to a 33% return on our investment. If you want to break it up into an IRR, it's basically an 8% IRR. Now, again, they haven't sold the building, or in this case, buildings. So, we're still hoping for that 13 to 15% return. But right now we're in the middle of it and it's just flowing along as they projected, which is wonderful. They've returned $27,000 of our original investment, which ultimately means they've returned to almost 55% of our original investment. And we still have invested in the deal $22,633, and the deal continues on. All right. So hopefully that shows you what a typical deal looks like. Again, this is one particular deal, but it's a pretty normal scenario of how it's playing out. And so far, so good. It's a fantastic, so far I'm very pleased with the results of it. Feel free below to shoot me an email. There should be a button to reach out to me. I'm happy to send this Excel document over to you if you want to take a look at the numbers, in more detail. And also, I'm more than happy to discuss your personal situation with you in terms of whether it makes sense to add real estate to your particular investment portfolio and what kind of proportion we're talking about. There are fantastic tax benefits to it. I'd love to talk to you about your particular situation. That's all for now. Safe investing to you. Bye-bye.